So again, not something I'm going to linger on, but just to give a little bit of context. Most people have come to think of the fully amortizing level pay fixed rate mortgage as the most common type. And maybe I should be very specific about that, because oftentimes if someone simply says, gives you a term and a size and an interest rate, in other words, I got a $400,000 30-year loan at 4%. And if they describe that as a fixed rate mortgage, unless qualified otherwise, most of the time people would take that as what I described before as a level payment, fully amortizing loan. Level payment, in other words, at the time you create the mortgage contract, the contractual payment is for the same dollar amount month in, month out over the life of the contract. And by the way, there are bi-monthly mortgages where someone will pay twice a month, but that's such a small piece of the market, I'll probably say monthly as if that's the norm, and it is for the most part, but understand there are a few mortgages that someone will pay twice a month. And believe it or not, that dramatically reduces the interest all over the life of the mortgage, which is why some people contract to do that. But I'll lapse into monthly and treat that as the norm, because it is for the most part. Understand there's a little bit of an exception to that. But if one had contracted had taken out one of these fully amortizing, level payment, fixed rate mortgages, if the mortgagor, the borrower, was making exactly the payment due under the contract, they were making no prepayments and no late payments, they were simply making their monthly payment in a timely fashion, by the time they had made the 360th monthly payment, not only would they have paid all the interest they owed on the loan, they would have also have fully repaid, i.e. fully amortized the principal as well. So there's no big payment at the end the way there would be on a balloon type mortgage. But while most people have come to think of that as the standard type of mortgage, one, it isn't in most places around the world. Most places around the world, mortgage loans are floating rate loans, not fixed rate loans like we have in the United States. And up until the 1930s, the norm were interest only or balloon loans. And of course, an interest only loan, we'll look at them in more detail later, but it's very descriptive. An interest only loan, the borrower simply owes the interest until the mortgage is due. And on a balloon loan, there are two significant time periods. There's a balloon period and an amortization schedule. So I might have a 5-year balloon, but with a 30-year amortization schedule. Well, that would mean that over those first 5 years, or I should say the first 59 months, the mortgagor is making payments as if they were going to pay the loan off over 30 years, but then in the 60th month, at the end of the 5 years, the size of the payment balloons because all the unpaid principal comes due right at that point in time. Well, naturally, with an interest-only loan, unless the borrower is making any voluntary payments, there is no amortization of principal. And on a balloon loan, because of the nature of the amortization schedule, we'll look at it in more detail later, but in the first months of a fully amortizing loan, a very small piece of what you're paying is repayment of principal. The vast majority of what you're paying is interest that's owed on the outstanding principal. So even though 5 over 30 years is about 16% of the life of the loan, you've probably only paid down about 6% of the principal or something like that. So on an interest-only loan or a 5-year balloon, there's a huge amount of money that comes due at the end of the 5 years. And most of the loans, as it notes up there, were interest-only or balloon with 5 or 10-year terms. Well, people weren't saving up enough money to pay off the principal at the end of the 5 or 10 years. They were, in effect, refinancing at maturity. Well, note that works just fine as long as your property has held its value, but if there's been any significant decline in value because you were either not paying any principal on an interest-only loan or it only repaid a relatively small amount on a balloon loan, any significant decline in property value meant you ended up with a lot of underwater mortgages. Now, property values declined by how much in this recent financial crisis, or the financial crisis 2007-2008? I've seen estimates that run from the low 20s to the high 20%. If you look at the average across the country, obviously in some markets like Phoenix or Miami, property declines were significantly more than that, especially if you bought a condo on one of the high rises in Miami. Well, we don't have good statistics because you didn't have any good indexes of residential real estate values until the 1940s or 50s, so we don't really have a good insight into exactly how much property values fell. But the academics who have studied it, by looking at the returns on real estate investment trusts that invested in real property back in the 1930s, estimated that property values declined by some 20 to 25%. Maybe not even as bad as we suffered in the most recent financial crisis. But when the predominant type of loan is interest-only or balloon, if you have a 20 to 25% decline in property values, the vast majority of mortgages are underwater. And that's exactly why the government, when they created Fannie Mae and FHA, Federal Housing Administration, in the late 1930s, they intentionally set Fannie Mae up with the goal of repurchasing, or I should say purchasing mortgages from banks, so banks had more money to turn around and make mortgage loans as a way of getting more capital funneled into residential property. But to encourage, or maybe I should say to create a situation where you wouldn't have so many underwater loans, the government said the only sorts of loans Fannie Mae will be able to buy from banks are the fully amortizing type. So that's why the banks started making primarily fully amortizing loans, because they wanted to be in a position to sell their loan portfolios to this government agency once that mortgage loan purchase program got up and running. Now, there was a little bit of a program in the 40s and 50s, but it never really took off until the 1970s. But that's why the fully amortizing loan became the predominant type, because the banks, or mortgage lenders more generally, wanted to be in a position to sell their mortgages off to that government program once that program really got cooking. And